Camtek beat consensus for its Q2 2026 earnings.
They did. They reported Q2 revenue of $133.2 million, which beat the $130.44 million estimate.
Right.
So that's an 8% year-over-year and like a 10% quarter-over-quarter increase.
And non-GAAP EPS came in at 78 cents, beating the 76-cent estimate.
But the real story is the guidance. It's incredibly aggressive. Management guided Q3 revenue to somewhere between $158 million and $160 million.
Which is a massive 20% sequential jump.
Exactly. And on top of that, they're projecting more than 30% revenue growth in the second half of 2026 compared to the first half.
So naturally, the stock reaction was violent. Shares gapped up 9.39% pre-market to $169.94.
Yeah, hit an intraday high of $170.18.
But then it just faded significantly. I mean, institutional investors stepped in, locked in profits, and it closed the first full trading session up just 1.77% at $158.10.
It was a classic beat and raise on paper, but that intraday fade tells us the market is digesting something far more complex underneath those headline numbers.
Which is exactly what we are unpacking in this deep dive. What exactly is fueling this massive 20% sequential revenue jump guided for Q3?
The short answer is the global AI data center build-out.
Right.
But specifically for Camtek, it's their advanced packaging segment, or AP. That accounted for about 75% of Q2 revenue, and management thinks it'll hit 80% by year-end.
Wow, 80%.
Yeah, CEO Rafi Amit actually noted that AP revenue is expected to grow an astonishing 45% in the second half of 2026 versus the first half.
Here's where it gets really interesting. Think about traditional semiconductor manufacturing, right? It's like building sprawling suburbs.
Sure, spread out.
Right, the chips are laid out flat. But with advanced packaging, it's like building a massive, tightly packed skyscraper to maximize compute power in a tiny footprint.
That's a great way to look at it. Because of the unprecedented demand for AI infrastructure, and specifically HBM4.
It's high bandwidth memory, right?
Exactly, HBM4. They have to stack these ultra-thin memory chips directly on top of each other.
Which makes Camtek's inspection equipment essentially the vital building inspectors for these complex skyscrapers.
Because if you have one tiny microscopic flaw on, say, the fourth layer,
the whole skyscraper is ruined.
You have to throw the whole multi-thousand-dollar stack in the trash. So the foundries absolutely need these newer inspection systems.
The Hawk and the Eagle G5.
Right, the Hawk and Eagle G5. Those made up about 50% of systems revenue in Q2 alone.
And the order intake momentum is just staggering. Management reported over $600 million year to date.
Yeah, giving them visibility stretching well into 2027.
But if revenues are breaking records and the backlog is $600 million, why did the stock fade from its intraday highs? We need to look at the costs.
Yeah, looking under the hood, the margins are, well, there's a big divide between the GAAP and non-GAAP numbers.
The non-GAAP metrics look solid, I'll give them that. Gross margin at 51.4%, operating margin at 27.0%.
And they have a target of 30 to 32% by year end.
But the GAAP metrics paint a totally different picture. GAAP net income actually plummeted 31% year over year, down to $23.3 million.
That's the friction right there. Operating expenses are growing much faster than revenue. Revenue is up 8%, but OPEX is up 29%.
29%. That's a huge jump.
Driven by heavy R&D and SG&A investments. Plus, the quarter absorbed a $7.7 million one-time tax expense.
And don't forget the costs related to the recent acquisition of Visual Layer.
Right, which they bought to add to their AI inspection capabilities.
And this is why I have to ask, is Camtek falling into the trap of growth at any cost?
It's a fair question.
They are buying revenue through M&A like Visual Layer, but with operating expenses vastly outpacing revenue growth, how much of this top-line explosion will actually flow to the bottom line for retail investors?
That is exactly what Wall Street is trying to figure out. Integrating a software company like Visual Layer into a hardware business is rarely smooth.
No, it never is.
So that friction we're seeing in the income statement, it's completely mirrored in their working capital on the balance sheet.
The cash flow conversion was undeniably weak. Q2 operating cash flow was only $12.2 million.
Which is only 31% of their non-GAAP net income.
Right. You want to see those numbers much closer together. And then accounts receivable spiked to $153.9 million.
Which pushes their days sales outstanding, the DSO, to a highly stretched 105 days.
So what does this all mean? Does this massive extension of credit mean Camtek is essentially acting as a bank for its Asian clients just to secure these massive order backlogs?
It certainly looks that way. They're extending incredibly favorable terms.
Wait, really? Over 3 months just to get paid?
Yeah, 105 days. And at the same time, they're intentionally building up inventory to support that massive $600 million backlog for 2026 and 2027 deliveries.
So they have cash going out the door to build the machines today, but they're waiting a third of a year to get paid for the ones they already delivered.
Exactly. It completely strings their working capital. And we haven't even touched on the geopolitical risk yet.
Oh, the geographic concentration is a severe risk. Asia accounted for 92% of Q2 revenue.
And if you drill down, China is expected to represent roughly 45% of total 2026 revenue.
45%. That exposes the company to incredibly high geopolitical and export policy risks.
Absolutely. The U.S. and its allies treat advanced semiconductor manufacturing as a national security issue. If new export bans hit, a huge chunk of that Chinese revenue could just vanish.
The Wall Street analyst definitely noticed these friction points. Despite the big revenue beat, firms like Stifel lowered their price target from $185 to $170.
B. Riley dropped theirs too, right?
Yeah, from $220 to $200. And they specifically cited compressed industry multiples and that heavy China exposure.
The market is clearly weighing that phenomenal AI-driven top-line growth against these emerging working capital and geopolitical risks.
It's a really delicate balancing act. You have this incredible demand for building AI infrastructure, and Camtek has secured their place as the essential building inspectors.
But the balance sheet shows the strain of holding that position.
Which brings us to a final thought for you to consider as you look at your own portfolio. Camtek is aggressively building inventory and extending long payment terms to its customers just to fulfill this $600 million backlog.
Right, tying up a ton of cash.
So what happens if the global AI infrastructure build-out hits a sudden speed bump?
That's the million-dollar question.
Will that massive backlog act as a protective moat, keeping them safe? Or will it quickly become a costly liability tied up in raw materials and unpaid invoices for AI skyscrapers no one is finishing?
It's something every investor needs to watch closely.
Absolutely. Make sure to follow the show for our daily earnings coverage so you never miss these under-the-hood details. Catch you next time.